All right. Please settle down, please. Thank you. A couple of announcements. The first one, which is probably the most relevant one, is that the final exam for the course will be on Thursday, August 11th, from 2 to 5 p.m. So it will not be on Friday. It will be the day before. And because the exam's on Thursday in the afternoon, it's pretty much useless to have a class in the morning. So the class in the morning, which is from 10 to 11:15, I will be available here, either in the classroom if you prefer that, or in my office, whichever, for any questions. The review session would be on Wednesday, the day before, which is August the 10th. Okay? So let me just write it down here for people who are just coming in. And we'll have the same arrangement as we had for the midterm. Half the class will be here and half the class would be in the Davis Auditorium. Everything, cumulative exam. It's not, there wouldn't be any direct question on linear programming, but you cannot assume that you can forget linear programming. So there won't be, in the final exam, there won't be any direct question asking you to do linear programming, but if it is in context, you cannot complain to me and say that, well, linear programming was in the midterm, so I can forget about it. Okay, there is a homework that's been posted. Now, there will be another homework that will be posted next week, but another bit of a problem that I'm facing right now is how to deal with the stuff that we'll teach between the homework and the next one. So what I'm thinking is I'll just put up a sample set of questions and solutions all at the same time. So you can just look at the questions, do them yourself, and the solutions will be available immediately, so you can take a look at what happened. So there'll be a homework that's this homework and the next homework that you have to do on your own, and the last one would be just posted.
Can you also let us know the relevant sections in the class?
Yes. Ali would again send out an email exactly telling you which relevant sections work. Okay, just to give you a roadmap of where we are going to go now from here, I'm going to just talk about portfolio selection, just summarize the story from last week. Then we're going to talk about in the morning about some general methods for solving nonlinear programs. There are no closed form solutions for general nonlinear programming, so we'll just give you ideas of how the stuff that you've learned in quadratic programming extends to general nonlinear programming. The two new topics that's still left over in this course is integer programming and dynamic programming. We will probably start integer programming this afternoon. It all depends on how much it takes me to do the general nonlinear stuff. And the last topic would be dynamic programming. Okay, so what's the story that I want you to remember from portfolio selection? You should know, so here is sort of the basic stuff that you should know. You should know what a Markowitz problem is. Or Markowitz QP. You should be able to sort of, in your sleep, be able to write it. If I tell you a mu and a sigma, you should be able to just tell me what this is going to be. And it's pretty simple what's happening. The other thing that you should know is the idea of efficient frontier. And so far, when I mention all of this, I'm talking about with no riskless asset. And also the idea that it can be generated by two funds, which in the financial economics literature is called two-fund separation. This we saw that we could construct the efficient frontier by just looking at two portfolios, G and G plus H, in the language of last week's or Tuesday's lecture. In the homework, you'll be asked to show that you can in fact generate the efficient frontier by just picking any two efficient portfolios. You don't really need to look at just those two. Third, we introduced the idea of a riskless asset. And now the efficient frontier is a straight line. And we made some arguments about what this efficient frontier looks like when the risk-free rate RF is less than the return on the minimum variance portfolio, greater than the return on the minimum variance portfolio, and exactly equal to. And we also argued last week that, or Tuesday, that the only way the market is sustainable in equilibrium is if the risk-free rate is actually less than the return of the minimum variance portfolio. In the homework that was assigned, you will work out these things for just a 2-asset case to get you a feel for how the covariance or the correlation between assets affects the shape of the efficient portfolio. All right, the fact that this is a straight line ends up giving you that, let's say, the expected return on any portfolio let's call this psi, has this relationship. The expected value of the return on psi is equal to beta times the expected return on any efficient portfolio plus 1 minus beta times the risk-free rate. And what is beta? Beta is defined as the covariance of the return on psi, the covariance of the return on the efficient portfolio corresponding to some return level alpha divided by the variance of the return of the efficient portfolio. So let me just emphasize that this guy is efficient. So here, both of these, they refer to the same portfolio. So one of them is an efficient portfolio. This one could be anything. And all of this is simply just simple algebra. All of the thing that I want you to remember is all of this thing follows from this simple formulation of a QP and adding a riskless asset. Once you do these two things, all of this is simple algebraic manipulations. It's nothing, there isn't any sort of an economic content in it. You can then take this quantity and test it in the market if this is really true. If it is true, then you will believe that model and work with it. If it's not true, then you'll dump that model and say this doesn't work. There is still debate on whether, let me just finish off the story. The last statement that we made was that the market portfolio is efficient. What is the market portfolio? It's basically the portfolio generated by looking at the total wealth invested in the market. Look at all the assets in the market, collect up the capitalization of all of these assets, and divide it by the total capitalization. Whatever portfolio you end up getting, that's a market portfolio. If a 2-fund separation holds, or in this case you end up getting 1 fund separation because you only hold the risk-free and 1 mutual fund, under these circumstances, you can show that this market portfolio is efficient, and therefore, in place of this efficient portfolio, I can start using the market portfolio. And you end up getting that the expected return that's coming from here back up here on any portfolio R tilde psi is equal to beta of psi with respect to the market times the return on the market minus the risk-free rate plus the risk-free rate. It's just, I've just written it, I just collected together terms and just put it in a form that's just a little bit more convenient. Then you look at the case that every asset is a portfolio. It's a portfolio which just invests the entire dollar into that one given asset. So if you look at what that statement up there implies is that the expected return on any asset, R tilde I, but that we know is equal to mu I. Mu I was the expected return on any given asset. That is in fact equal to the beta of the asset with respect to the market, return on the market minus RF plus RF.
Sir,
Yes?
I still don't quite understand what this beta. It's just a constant, or
Yes, it's a constant. It's a number.
and what can it? Because I've heard of it before. What is it? What does it usually tell us? Though?
Okay, I was. Hold on one moment. I'll get to that question. So the remark there was, what is beta? For now, think of beta as a number. It gives beta. So for those of you who have done linear regression, beta comes out as the regression coefficient that comes in front of it. The R squared is the remaining part, and this is sort of the taps that come. This tells you what is the weight of each of the independent variables in determining what the dependent variable is. But for now, you can think of it as if how close are R tilde phi and R phi divided by the variability in a given asset. But we'll come to it in a moment. Let me just rearrange things here. You end up getting mu I minus RF. This is the excess return, return in excess of the risk-free rate, is equal to beta IM of alpha M minus RF. What? This is kappa. Both these statements are capital asset pricing model. So this stands for CAPM, where C stands for capital, A for asset, P for pricing, and M for model. So what the capital asset pricing model says is that if you're looking at the excess return on the assets, that is completely determined by what the beta of that asset is and the return on the market. Okay? So let's try to figure out, the basic content here is the following. The economic content of this statement is saying that if everything that we have assumed so far is true, which means that investors invest according to this quadratic program with a riskless asset, then they will hold portfolios that can all be described by one fund, which means that the market is efficient, which means that you end up getting this model. Then all the returns on, so what is happening here is on the, let's say, on the x-axis, let's just plot a function of beta. So what this is saying is that if you look at the straight line, so this is a constant. This does not depend on the assets. Alpha M is a return on the market. It's some constant which doesn't depend on individual assets I. It doesn't depend on what I is. All the dependence of this mu I on this factor alpha minus Rm is completely captured by this constant beta. Okay, RF is a risk-free rate that's given. So what this says is that if you draw this straight line, which is basically alpha M minus RF times beta. So beta is what I'm plotting on the x-axis here. It should have gone through 0. So let's say here is 0. I've just shifted my y-axis, so that is 0. So what I'm doing is I'm just looking on the right-hand side as a function of beta. Alpha minus RF is a constant. It's just a straight line in terms of beta. And what that capital asset pricing statement says is no matter which asset you pick, all of those assets should lie on this. Their betas could be different, but their excess returns must all lie in this straight line. They cannot be out of this straight line, which is a pretty serious statement. It's saying that you give me this number, alpha minus RF, and I'll give you the straight line on which all the asset returns should lie. Typically, if you look at data, it'll never happen this way, but at least it'll be around this line. You could think of this line as the first approximation to what the returns on the assets is going to look like. If the real returns lie somewhere like this, yeah, you can sort of say, okay, it works. There's a lot of discussion on, still going on, whether CAPM is in fact true in the market. And there are defenders of CAPM who believe as if CAPM it's a God-given truth, if you believe in God, that is. And they would go through all kinds of hoops to, in fact, prove to you that this is true. And anytime there's a variation seen, they're going to come up with different objections. For example, one of the most popular objection is about the market portfolio. If this line fails, one way to say why it fails is because you didn't define the correct market portfolio. If you don't define the correct market portfolio, you don't get the correct market return, you don't get the straight line perfect, so you might see systematic variations from the straight line. What is the problem in the market portfolio? This market portfolio effectively talks about anything that's traded in the market. It's the capitalization of everything that's traded in the market divided by the total capitalization. If you're looking at equity markets, this is fairly well defined. You can look at the New York Stock Exchange or whatever stock exchange you want to look at the capitalization, that data is available. But there is other kinds of things that are not as liquid, like real estate, like gold, commodities, whatnot. They all go into this market portfolio. Why? Because, after all, people are interested in investing in those quantities. So when they are making their investment decision, that should go into their QP. And if that goes into their QP, that should be reflected in the market portfolio. And if you don't include that in the market portfolio, your line would go off. So there are ways of defending this by saying this wasn't computed correctly. Yes?
Here, this beta would represent the risk of any particular company, the riskiness?
Yes, I'll come to it in, yes. It's sort of, we will consider that in just one moment, and we'll talk about it. We'll consider two cases, and it'll become clear what that beta is doing. All right? Okay. So for now, all we know is that if you believe all of this story, all the asset returns should fall on this straight line. Now let's try to get an idea of whether this makes sense. For the moment, let's not even go into the discussion on whether it is true in the market or not, but let's just ask ourselves, does this structure make sense? So what this is saying is, let's consider two assets. Let's say asset A and asset B. And let's say that the asset A's beta is positive, both of them are positive, but beta A is strictly greater than beta B. Okay? Then you end up getting that the excess return, mu A minus RF, is actually greater than mu B minus RF. Right? Just from that expression over there. The constant alpha M minus RF is, okay, before we get into another thing, why should this be, when I'm writing this statement, I'm implicitly assuming that alpha M minus RF is positive. Why is that the case?
Return on the market is always greater than the rssk rate.
Why? Yeah?
Otherwise, there will be no interest to go in the market.
Yes, the market will not exist. The market will just collapse. Everybody will be shorting that market. There won't be any trading going on. The market does not exist unless you're getting some risk premium. Meaning that if you're going into the market, meaning you're holding risky assets, you should be compensated for holding those risky assets. Otherwise, you will never want to hold the risky assets, which means that alpha M minus RF must be positive. This is the same story as we talked about, that the A over C must be greater than RF. A similar story is about what should happen to the rate. Okay. So if mu A minus RF is greater than mu B minus RF, does this make sense? Let's now forget about this entire story that we have. How the QP came, how the efficient portfolios came. Something happened in the background, and at the end of the day, we end up getting this straight line. We don't know how we got this straight line. And now we are saying is, if beta A is greater than 0, beta B is greater than 0, beta A is greater than beta B, then its expected return on asset A must be greater than the expected return on asset B. Now let's try to argue this from an economic perspective, why this must be true, or at least it makes sense. It can't be that this must be true, but at least it makes sense. Does anybody want to volunteer? Yeah?
That if any company is more risky than the other, you give it more risk premium, you allocate more to that, in the sense that if you want people to invest in it,
Yeah?
there has to be some incentive, as you already said.
There has to be some incentive. That's one. So one explanation for this is the following. If beta A is greater than beta B, it gives you a sense for how much randomness does a particular asset have as compared to the randomness in the market. If the randomness in the market, if it's higher than the randomness in the market, you have to be given higher returns for you to be holding that asset in equilibrium. Otherwise, this asset will just disappear from the market. Either you should be compensated for holding that risk, otherwise nobody would hold that asset and it will just vanish from the market. Similarly, over here, if it's less, then, so what you end up getting is that beta is a measure of how risky is a particular asset or a particular portfolio as compared to the market portfolio. If beta is equal to 1, then the return on that is exactly equal to the market return. If beta is greater than 1, then the return is actually greater than the market return. And the idea is that if it's more risky, you have to be compensated for it. Is this sort of clear to people? Questions about it? Yes?
In the regression framework, beta is like the correlation between the market and the is this exactly the correlation term between the market and the
Well, is it exactly the correlation term? No, because the correlation would have the square root of the variance of the two quantities there. Right? So beta, so the correlation between two returns would be the covariance,
divided by beta.
R psi, R phi, or let's say R alpha divided by the standard deviation, which is the square root of the variance of R phi times the variance of R alpha. So it's slightly different from, so beta is not that. Beta is as if I'm replacing R psi by R alpha. So it's a slightly different concept, but it's close enough. And the reason we think of beta as a sort of a ratio of randomness is because we are not normalizing by the variance of the other asset itself. We're just normalizing by the variance of the market. Okay, question?
Beta always has to be greater than 0?
No. What would negative beta mean?
The market rises, then this will drop.
Okay. So now, does that make sense in terms of the return that you're getting?
I didn't hear what he said.
Okay. The question was that. So your question was does beta have to be positive? No, because the covariance between two assets could have any sign. It could be positive. It could be negative. So there is no reason for one to expect that beta is positive. Okay. So let's consider the case where beta is negative. So if beta is negative, this implies that for that particular asset, mu I minus RF is actually less than 0. So does that make sense? That the return on that particular asset should be less than the risk-free rate? So, which is the same thing as saying mu I is less than RF. Why would you even care about this if it is less than RF? Why would this asset be in the market? You could short it.
Or you can
Could be used as a hedge.
You can just use it as a diversification tool.
Exactly. So both of those things are there. You could either short it or you can use it as a diversification tool. This is negatively correlated with the market. So the variance is always non-negative. The moment beta is negative, it means that the covariance between the return on this asset and the return on the market is negatively correlated. When the market goes down, this asset is going up. So one way to think about why this thing is so, another way of answering the question why mu I is less than RF is to think of it this way. So basically today you're paying for something that you will get later on. If you get a payoff later on, you're paying for it today. This is the same story that we did when we were trying to price different assets. Always it's a story that you get a return in the future, you pay something for it today. If you're getting a negative correlation between the asset today and the market, then what you're saying is that this gives you a payoff when the market is down. It's more likely to give you a payoff when the market is down as compared to something else which is going to give you a payoff when the market is up. Between these two assets, let's consider two different assets. One for which beta is less than 0, let's call it beta I, and another beta j is positive. Let's not worry about the returns for the moment. And let's say they both pay $1 tomorrow. The payoff from this, not the return, just the payoff, they pay $1 tomorrow. Which one would you be paying more for today? If beta j or beta I? Think about it a little bit more. You already have this market portfolio that you can go and put your money into, right? There is a mutual fund out there, S&P 500 index fund. That's nothing but a market portfolio. I can buy the market portfolio. This fellow says, I'm going to pay you $1 every time the market goes up. This fellow says, I'm going to pay you $1 when the market goes down. Which one would be more expensive? Beta I would be more expensive. This is the guy that you want to have in your portfolio for the situation where you cannot get it from the market. This is kind of useless. I can go and put it into the market. It has less risk. I can get this return from there. This fellow is a hard to construct portfolio because it's something that's negatively correlated with the market, which means that the price for this asset would be higher today. If the price for this asset is higher, for the same payoff, it means that the return on this would be lower. Yeah?
If you have a market portfolio, though, like doesn't CAPM say that every asset is already part of the market portfolio? So if every asset is part of the market portfolio, how is it possible to get a beta that's negative? Because isn't covariance going to be positive if every single asset is in the market portfolio?
No. Why? The fact that something is in the market portfolio doesn't mean that its covariance should be negative. All you're saying is that the market portfolio exists. This asset could be heavily negatively correlated with some asset which is in the market portfolio with a very heavy weight. So the fact that it's a convex combination of assets doesn't mean that you cannot have beta negative. It simply means that this fellow is very heavily negative. I don't know. I mean, this could be, to give you an example, motor cars are a part of, or at least automotive used to be, I don't even remember now. Dow Jones, it's a big component of Dow Jones, big component of various market portfolios. If you've got something else, I don't know, airplane, which is a different, negatively correlated with a big chunk of assets there, it could have a negative beta. And the way this basically works, so right now the point is that one thing you should keep in mind is these statements are about returns. They're not statements about prices. So typically when the price is high, return is low. And that's another way of explaining the same thing. Okay? Any other questions? Question?
So if we define data as how is a measure of randomness with respect to the market,
Yeah.
the market also moves in cycles. So the inherent randomness of the market also changes.
Aha. Very good question. But this entire edifice, this entire superstructure that we have created assumes that there is one sigma that's from now until eternity. There is one expected return from now until eternity. There is no cycles in the market. Or at least there are two ways of defending this theory. One thing is to say that the model assumes there are no cycles in the market. Another way to say is that the investors are so myopic that they don't care about the cycles in the market. In that situation, all of this holds. So what will eventually happen if we go along that direction, what will eventually say is that this line keeps shifting. There's always a straight line, but if you look at that straight line today versus look at it 5 years later, its straight line has shifted. But at any given snapshot, there is a straight line on which all the assets live. But that's a bit of a problem because if the market shifts quickly or things are going off in different cycles, then you don't expect this straight line to be a straight line anymore. You expect it to move. And that's one of the opponents of CAPM will tell you that is what is happening in the market. I mean, to some extent, there isn't a consensus on what the correct market model is. And it depends on what application you want it for. If you're trying to hedge something from now until 25 years later, you better believe in cycles. You better think about cycles. If you're trying to invest in something from now until the next 6 months, you don't care. CAPM might work for you. So the time scale over which you have to make decisions also matters to these models. Okay, so the model presented here assumes everything is stationary, nothing changes, and its changes are not reflected in the model. Okay, any other questions? Yeah.
Considered as a one-period model, something like that. It
Yeah.
can't really be it can't be extended into continuous time. I think this is just a.
Well, you could either call it a one-period model, or you could call it. Maybe it's okay. Two ways. So the question is this a one-period model? There are two ways of answering that question. One way is to say yes, it's a one-period model. Another way to say is that it's a model in which investors are not looking far away. They are myopic investors. So if everybody is a myopic investor, then in the next period the same game repeats itself. On the other hand, if investors are not myopic, and typically they are not, because say they are looking to retire in 10 years. So their actions today would be very different from their actions 8 years away, because now they are trying to retire. The decision they are going to make is going to be very different, and so time correlation comes into the picture. One way of defending this model is to say, well, investors are not looking into the future. They're just looking period by period, and you'll get the same result. Or it's a one-period model, whichever way you want to defend it.
But if I have to take an estimate of correlation and covariance, which one would I look at a shorter period or would I look at longer period? Which would be sensible in this case?
Sensible in this case would be shorter period. So the question is, when I'm looking at correlation and covariance, what should you do? You should look at shorter periods primarily because things shift. And so the market would shift if you take a much larger interval. But then you get into this mess that we are trying to compute the covariance of a market which has thousands of assets. The covariance matrix has thousands, maybe even millions, whatever, n squared entities. And then I'm telling you, well, you know what? You have to estimate it using a very short time interval. So you've got a mess on your hands. One way of escaping that is to say, well, there are millions of assets, but there are a very small number of factors. And therefore, the covariance matrix that I'm concerned about is only of the factors, not of the market itself. Factors I can estimate. And they are probably more longer-lived than assets themselves. They are stable over a longer period than the market itself. And those are all practical details. So we'll, in FE1 in the fall, we'll look at different market models. Here, all I want you to sort of focus on is the fact that if you take an optimization problem, look at its optimal solution, and mix it up with some judicious use of financial economics, you end up getting some models which are testable in the market. They may be all wrong, but at least you have a nice way of getting to models from optimization problems. And this will repeat itself when we do FE1. Okay. So that was basically closing up the story of Tuesday. Any other questions? All right. So next, what I want to do today, in whatever time, I have tons of time, good, is tell you what happens when things are not quadratic. So far, all we've done in the nonlinear programming story is figure out how we can classify nonlinear programs. And then from there, I just jumped and said, well, let's go and solve a QP. Now, what I want to do is tell you that if you know how to solve a QP, you can do a lot of stuff. Approximate, but at least you can do a lot of stuff. And to do that, what I want to think about is, in solving this QP, these are the 3 steps we did. When we started looking at active set methods for quadratic programming, what are the main steps that we did? We chose a descent direction. We are sitting at a point. We don't know what to do from there. We want to move from that point somewhere. What did we do? We threw away the inequality constraint QP and constructed an equality constraint QP. In this particular equality constraint QP, I can compute this D exactly. It's an inversion of a matrix. I invert that matrix, I get my D. So the D at this point just tells me that if I move in this direction, I'm likely to improve my objective. Either minimize my objective or maximize my objective, depending upon what I'm after. The next thing I need to do is figure out how far can I go in this direction. And we did that in the case of active set by looking at the inactive constraints. This was done by looking at just the active constraints. This was done by looking at the inactive constraints. I figured out what is the largest lambda. All right? So once I know these two, I know how to keep moving. Sometimes I get stuck. I get stuck when d turns out to be 0, which means I can't move. Then I looked at the dual variables to try to drop some of the active constraints and keep moving. The final thing that I also need to know is how do you get a stopping criteria? How do you stop? When can you just say, okay, this is it. I found the best possible point that I can find using this technique. And we use the multipliers again. If the multipliers v have the right sign, we'll say we can stop. All nonlinear programming methods basically have these steps. They start from some point x, from some feasible point x, and at that point they somehow create a direction d at the point x bar. From there they find a step length, lambda, and keep going until stopping criteria. And in most of these algorithms, somewhere lurking in there is either a QP or an LP. And the way it comes about is here. You somehow get this direction by solving either a quadratic program or a linear program. Sometimes it's unconstrained, sometimes it's constrained. If the original nonlinear program was unconstrained, you will solve an unconstrained problem. If, on the other hand, it's a constrained problem, then you solve a constrained QP or a constrained LP. From there, you get to get the direction and then move in that direction somewhat. This step typically is the hardest. And we'll talk about it in a moment, why this becomes the hardest step. Stopping criteria is usually very simple. So let's think about this. Suppose I was trying to find a local minimum for a QP, for a general nonlinear program. What kind of stopping criteria would you use? Of course, we know the multipliers. That in general nonlinear programming, the multipliers are a hard thing to do. So what's the simplest stopping criteria you could think about? If I produce for you a point x bar, somehow, I've done a lot of iterations and I produce for you a point x bar. What you want the stopping criteria to tell you is that, okay, I'm satisfied at this point x bar. You don't have to move. So what is the natural condition one would want to use here? What is 0? Oh, no. I don't even know d. I just arrived at this point x bar for now. F prime, yes. What else? Yeah, so this typically comes from first and second order optimality. This is the stuff that we have done before. So typically what you do is you somehow create a point, x bar, and you check to see whether you can stop here. And the way you check to see whether you can stop here is to look at the gradient. If the norm, typically the gradient would never be 0. Numerically, things, unless you're extremely, extremely lucky, you won't get a gradient vector which is exactly equal to 0. It's just impossible. So what you do is you relax that condition by saying, well, it's not 0, but its norm, its length is almost 0. Fine. That means at least it's a stationary point. Then you look at the Hessian at that point and say whether it's positive semi-definite. If that is the case, then you declare that this current point is approximately a local minimum, and you're done. We can't ask for more because this step, finding the d, is created using gradients or using local information. And I'll show you some typical strategies in a moment. Since this is created using local information, I cannot find anything better than a local optimum. The only way I can say anything global is to argue that my optimization problem was convex, and therefore local means global. All right, so here's sort of the basic strategies that people use. One generic set of ideas are something called the reduced gradient method. So all of these ideas are about how do you get this d and how do you get the lambda. They generally start from a point find a D, find a lambda, keep going in this cycle until the stopping criteria is met. The stopping criteria comes from first and second order conditions. So the only thing I need to tell you is how do you get that and that. So in the reduced gradient method, suppose you had a nonlinear function f, but linear constraints. So you're looking at a problem. So let's just keep this story here. So you're looking at this kind of a problem. Minimize f of x. This thing is not working very well. Such that one is not good. That's annoying. A of x is less than or equal to b. Let's just say inequalities. And if there are inequalities, I've put two different kinds of inequalities to capture that. So, if there were no constraints, then the best direction to move would be in the negative of the gradient direction. The gradient tells you the direction of the steepest increase. I want to decrease, I want to minimize this, and therefore I'm going to go in the direction of the negative of the gradient. The negative of the gradient may be an infeasible direction. It may not satisfy this. So what's happening here is, here's the picture. Here's your set ax less than or equal to b. You're sitting at this point. This point is xt, a current interrupt. Alright? And now you compute the gradient here, and the gradient, negative of the gradient is there. So if this was an unconstrained problem, you would want to move in that direction because you know that is the steepest or the greedy direction to move in. So that doesn't work. So what do? What is the best thing that you would want to do here, or the greedy thing?
Move to the maximum in that direction. Move as maximum as possible.
As maximum as possible, or the other suggestion was to get a projection. Both of those statements are exactly the same. What you do is you try to project on. So do I really care about this constraint over there when I'm trying to find the projection? Or that one? No. Which are the constraints I care about when I'm trying to find the projection? Currently in the active set. Those are the only guys I care about. I don't care about the other people because they're so far away that they're not going to stop me from moving in any direction. This direction is feasible for this constraint, that direction is feasible for this constraint. It's kind of not feasible exactly for this one, but at least I can move somewhat before I get trapped by that direction. These are the two constraints that are really limiting me from moving. So what it says is that you compute a projection, P of t, I just call it P of t, of the negative of the gradient under the space of the primal feasible directions. These are the directions that I want to move in. The primal feasible directions at this point is what? I can go in this cone anywhere. So these are the primal feasible directions. So you get a projection of the gradient of the primal feasible directions, which is saying the following, that the negative of the gradient must be equal to its projection plus, look at the rows corresponding to tight constraints transpose lambda. Why come up with that expression? Because if you look at this, lambda, this is, and if you hit it with any primal feasible direction, you end up getting, this is equal to lambda transpose, or let me just write it the way it's written there, ATD transpose lambda, but this guy is equal to 0 for all primal feasible directions. So what that expression is doing is breaking up the negative of the gradient into two perpendicular directions. This is along the primal feasible directions, and that is perpendicular to the primal feasible directions. Do a little bit of algebra, you end up getting what this P of t should look like. It should look like this expression. From the point of view of this class, let's not worry too much about that expression. I'll give you a homework next week where you'll be explicitly computing these things so you will know how to do it rather than looking at this expression. Okay. So the story behind the reduced gradient method is the following. You've got a feasible set. You've got the negative of the gradient. You want to move in the negative of the gradient, but these constraints stop you from moving. So what do? you try to find the projection, the closest point on the space in which you can move. You find a point that's closest to this vector. And that, let's call it P of t. P of t is the projection onto the direction that you can move. So in this case, it will be a projection onto these directions, because this is the direction on which you can move, and geometrically what that will look like is this vector. So this vector here is your vector P of t, and that vector is that other junk, AT transpose lambda, perpendicular to the vector P of t. So now what you do is the reduced gradient just tells you, fine, you can't move in the direction of negative of the gradient, just move in the direction of the projection. That you can do. Do it. And how do you compute the step length? Well, all the constraints are linear. And therefore we know how to do that from QP. We just know how to figure out how much we can go. We come back to the new point, get another projection to the gradient, and I'm done. All right? So what we are doing here is, if you want to project it back into an LP or a QP, we are really solving an LP. We are solving a linear program to find out what P of t is. Another way of thinking about P of t is to find the minimum mean square distance to minus gradient of f of x transpose, in which case you're trying to solve a QP. Whatever you're doing, all you're doing basically is you look at the current point, look at the active constraints at that point, find the projection of the gradient into the space of the primal sets, and then now move. Go to the next point, do the same thing. Extremely greedy procedure, but works. Okay. What happens? So this is the case when you had linear constraints, but nonlinear objective function. What happens when you have both of those? Nonlinear f and nonlinear constraints. Well, we want to reduce it back to the case we know how to solve. Anytime you get faced with a problem that you don't know how to solve, try to make use of whatever you know. And we know how to solve this problem for the case of linear constraints. So what you do is just linearize the constraints. So this time, instead of this, you have some constraints which says gi of x is less than or equal to bi. So you don't like these constraints, so you just say gi of the current point x bar plus the gradient of gi at the point x bar transpose x minus x bar is less than or equal to b. Now we have a linear constraint with a nonlinear function. I know how to deal with this. So I go back to the case that's before, I find the projection to the gradient, and then I get a direction. Now things break down. Life becomes very tough. And the reason is this. Look at this possibility. That suppose, I can't draw it in 2 dimensions very well, but let's say, let me attempt to draw a 3-dimensional picture for you. What I'm trying to do is the following. Let's say you had a linear equality constraint. And a linear equality constraint would look like a plane in these 3 dimensions. And let's say on that plane you have some other inequalities defining the set. Okay, so this guy, this picture, is a linear come on. This is a linear equality, this plane. My entire feasible set lives on that plane, and these are some extra inequalities. All right, so if you were trying to do, so let's go back to the old case. We are trying to solve a nonlinear problem over linear constraints. At some point here, let's say, I found a gradient. Now the gradient actually points out of this board somewhere. So the first thing I have to do is find a projection. So I have to make sure that that gradient at least lies on that plane there. Then what you end up getting is this line again. Now, however much I move in this line, I am still guaranteed to lie on that plane, meaning I will continue to satisfy the equality constraint. Now, when I'm talking about a nonlinear constraint, what I'm trying to do is find a linear approximation. I can still look at the same picture here and claim that this is the linear approximation of nonlinear constraint. But now this particular plane is a tangent plane. It's no longer the nonlinear equality constraint. It's a tangent to the nonlinear equality constraints. And so the moment I start moving away from this point, I will go away from that nonlinear equality constraint. This is just a tangent plane, so the real constraint curves. The moment you move, you get out of that curve. And so you sort of have to move a little and project back to the curve. And you don't want to do that very many times, because every time you compute things, every time you try to solve for this projection, it's expensive. So what you really want to do is have an idea of how far can you go without kind of just going far away from this curve, such that projecting back would be hard. So computing this, how far can you move, becomes a really difficult problem. And a lot of work is still being done on how to do this. Step length is hard. And typically hard when you have nonlinear constraints. When you have linear constraints, everything's fine. Because once you find a direction, you're guaranteed that you will be on the equality constraint, you will not stray away from it. All you have to do is figure out how far to go. When you have nonlinear constraints, then you have this mess of going away from the constraints and returning back. Not a very pleasant thing to do. But I guess if you have it, you have to do it. All right. So in the homework, you will never be given this one. We'll ask you to solve a problem of this kind with linear constraints so that life is easy. This one is it's sort of more at the level of, we'll require an entire course in nonlinear programming for you to figure out how to do that part. Just keep in mind that this part is, so from a user's point of view, why do I care about knowing this? I care about knowing this because unless absolutely necessary, avoid nonlinear equality constraints. Nonlinear equality constraints are bad. It will screw up your optimization problem. It will take very long for it to find. It will typically not find a feasible solution because it has to stray away. So unless absolutely necessary, avoid nonlinear equality constraints. Nonlinear inequality constraints are okay. They don't really kill you that much. Question?
Can you tell us some examples of financial practices that would involve nonlinear function and nonlinear constraints?
So, for example, if you had trading costs involved, so typically, let's say you have some execution costs. Execution costs are typically quadratic in nature because of the price impact and so on. Now, what you want to do is, say, maximize the price that you get for your trade subject to some execution costs. You can formulate it in two ways. One way you can say, and since this execution typically happens on a number of steps, when you write out the constraints, you typically want to conserve money. You want to say that the money available for the next step is exactly equal to what I started with minus the execution cost. So you end up getting quadratic equality constraints. On the other hand, suppose you throw in a slack. When you solve the optimization problem, you know that if there is a way of doing exactly not losing any money along the way, the slacks will all go to zero. But when you formulate the optimization problem, formulate it as inequalities. You don't care. At the optimum solution, it will be tight. But along the way, it might be slack. Right? So when you do it that way, then you end up getting a problem which has nonlinear inequality constraints, and typically also convex. So things are much better than if you put in equality constraints. So it typically comes up in situations where the operation allows you a slack. At the optimum solution, the slack is zero, but along the way, it's not zero. But you shouldn't care about it, because you only care about the optimum solution. All right. So that's idea number one. So here, it's the same story as that big paradigm over there. Try to iterate, find a direction, find a step length, and stop somehow. But now, the next refinement of this is that instead of having a linear approximation for the objective function, have a quadratic approximation. So reduce gradients. essentially look at linear approximation of both the constraints and the objective. Then you have the next step, which is called sequential quadratic programming. Here, you take a quadratic approximation to the objective. But still a linear approximation to the constraints. And essentially what you're doing here is solving a QP. So you just go one step further. In the reduced gradient method, we stopped here. We stopped at this point and said, well, this is the approximation to my objective. Why? Because I'm going to look at just the gradient information. In the sequential quadratic programming, you go one step further and say, well, I'm going to look at both the gradient and a quadratic information. But the most logical thing to put here would be Hessian matrix. That's the second order Taylor series expansion. In practice, one doesn't use Hessians. One uses something which kind of is an approximation to the Hessian. The question is why? What don't we like about the Hessian?
It will be difficult to compute a Hessian.
One reason, absolutely difficult to compute.
To ensure that the eigenvalues are all positive, in order to ensure that it's positive semi-definite. Checking the conditions.
Why should a Hessian?
Good question. I mean, good comment, but it is. So the first. So why not the Hessian? Let's. This will come up in a moment. So the first comment was Hessian is difficult to compute. And that's very true. And typically, what also happens is, suppose you're trying to use these techniques to, I don't know, calibrate the prices of, say, a very difficult option. Then the function values, f of x, are typically computed by simulation. You simulate it to get very expensive. It's difficult to compute, expensive to compute, and unless one is able to show that there is absolutely a benefit to using the Hessian, why bother? Okay. The second comment was something to do with positive semi-definiteness. So this actually makes sense, but not in the way that was just mentioned. So what you care about is when you stop, that's when your Hessian should be positive semi-definite. Along the way, it may not be positive semi-definite. But it causes some other issue. This positive semi-definite business is important. And here's what is going to happen. So let's take the case of an unconstrained quadratic program. So this is not there at all. No constraints. So then I'm going to find the direction by solving this problem. Minimize the gradient of f at the point x bar transpose d plus 1/2 of, let's say I'm going to use the Hessian. So it's d transpose the Hessian at the point x bar times d. D is unconstrained. So what is the optimum solution for this problem? What is d here? We've done this over and over again. So d turns out to be what? Minus the inverse of the Hessian times the gradient at the point x bar. Right? So you immediately see a problem here, which is the Hessian might have 0 eigenvalues. So you've got a problem on how do you compute this guy. Okay, let's say that it doesn't have 0 eigenvalues. So this inverse does exist. Now let's try to move in this direction a little bit. So what will be the small change? It will be the gradient at the point x bar transpose d. This is the change in the function if I move in the direction d a little bit. You substitute for d, you end up getting minus the gradient of f at the point x bar transpose h x bar inverse gradient of f at the point x bar. So what do you want this whole expression to do? Without the minus sign, just the leftover part. What do you want its sign to be? Positive. You're trying to minimize. You found a direction. At least the thing that you can hope for is if I move just a little bit. I'm not moving aggressively. I'm not going very far away. At least locally, better improve my function. So if I want this quantity in here to be positive, what do I want this matrix to do? I don't know what the gradient is really. If I want to guarantee myself that no matter what happens, I will get a direction which is going to improve, what do I want this matrix to do? Positive definite. Positive definite because I need its inverse to exist.
So
And
why do we have to make it a positive anyway? Because there's a two part of the calculation. The second part can
which is the second part? There's only one part.
the 1/2 of a D transpose.
No. That is just used how to compute the D. This, I'm now going to move in this direction D, and I want to make sure that I improve in that direction. Right? So there is no, D has been chosen, and now I'm moving. So I have to make sure that this guy is positive definite. But along the way, until I reach the local minimum, maybe even at the local minimum, I'm not guaranteed that this is positive definite. Question?
The third line is actually the second order condition. It's like you found it.
No, it's not the second order condition. The second order condition, so what I'm doing here is I found the point x bar, and I'm pretending that this is what I'm going to solve to get my direction. I found the direction. This is what the direction is going to be. Now what I'm doing is I'm checking to make sure that if I move in this direction, do I improve? That's all I'm doing here. Now the problem is that I don't know what the gradient is. All I really care about is this bracket be positive. But I don't know what the gradient is everywhere. I don't know what the gradient vector is. So a sufficient condition that makes sure that this will always be pointing in the right direction and improving direction is to say that this is positive definite. It's a sufficient condition. It's not necessary. Because it's still possible that that guy over there, it has negative eigenvalues, but when you hit it with the gradient, you get a positive number. A sufficient condition would make sure that this is positive definite. So you need positive definiteness not because of local minimality, but because you have to ensure that the direction you compute is guaranteed to be a descent direction. So that's why, and Hessians are expensive. Hessians may not be positive definite, and therefore people just give up on the Hessian and say, well, just put some B of t there. And this B of t is assumed to be positive definite. You just make it to be positive definite. That way you know that whatever happens, you will find a direction that's better. And one very popular method, so let me just put some names here so that you know. This approximation is called the Newton method. Newton suggested that we find the direction using that approximation. What we are suggesting is to use this approximation. There are constraints, let's not worry about them. The story remains basically the same. Some B of x bar d, where this guy is positive definite. And these are called quasi-Newton methods. They're Newton-like in the sense that they use a second-order approximation, but they are quasi-Newton in the sense they don't use the Hessian. A very famous method in this area, which is in MATLAB, which is the default method in MATLAB, is called the BFGS method. I don't remember what the B, F, and S stands for, but the G I do. This stands for Goldfarb. And the reason I mention this is because Goldfarb is a faculty member in this department. So this is the default method in MATLAB to solve nonlinear programs. And all they're doing is constructing this matrix by looking at the previous iterates, by looking at the gradients of the previous iterates to get an approximation to what the Hessian looks like. Another related area is something called the conjugate gradient method, which is something that we won't talk about. but that also does something similar. One thing that should start becoming clear to you is nonlinear programming, unlike linear programming, is a very sort of dirty area of optimization. It's not very clean, doesn't have one method, it doesn't tell you do this and you're done. You have to come up with different techniques which will work for certain special cases, fail in others. When you come to those, you end up getting a different technique. Okay. So from this section, all I want you to remember is that if you know how to solve QPs, you kind of have the methods to solve general nonlinear programs by doing appropriate approximations. And these approximations are done by the packages that are out there for solving nonlinear programming. Another very general technique for solving nonlinear programs is something called the penalty technique. So now we're going to move away from this idea of that paradigm. So this is one paradigm where you find directions and you go. The second paradigm is to solve, so that's one. The second one is to solve constrained problems as unconstrained problems. So that's another big area, big way of dealing with problems. All the mess that happened, the reason this lambda was hard to get was because of constraints. If we didn't have constraints, there was essentially no problem in finding a direction and a step length. So let's go to a place where we can start approximating a constrained problem using an unconstrained problem. And one technique for doing it is the so-called penalty method. And let's just show it to you by example. It will become very clear what's happening here. It's a pretty simple idea. And here's what happens. So this is the constraint problem that you want to solve. You want to maximize that linear function, this is just a constant, subject to these three constraints. And one idea is to put a function mu. So here's what we want to do. Let's write it a general idea here. So you want to maximize some f of x such that, and let's say you have gi of x is greater than or equal to bi for I taking values 1, 2 up through p. So you have p inequality constraints. And what one does is gets another function, let's call it p of u, which is a scalar function. So x here is a vector, u here is a scalar, so it's a function from r to r plus. It goes from the real line to the positive. Every point it becomes non-negative. And here's what we're going to use. P of u has the following property. It's equal to 0 if u is less than 0, and it's strictly positive for u greater than or equal to 0. Well, let's not make it strictly positive there. It becomes tough to get it. Suppose you have this function. And here's an example. P of u is going to be the maximum of u and 0, or it's equal to the maximum of u and 0 squared. These are two different functions, both of which have this property. They have this property. Question?
Is some kind of a shadow price or something?
No, it's any odd function. Some function that I've just scoped up. The only thing I need about this function is this. And it's 0 for less than or equal to 0, and it's strictly positive for u positive. So one way I can solve this problem is to do the following. I construct a new function f of x, which takes the old function plus some number mu, which is greater than or equal to 0, the sum of I going from 1 through p, bad notations. Let's not call it p, let's call it m. Of the function p being hit with this quantity. So this is the ith constraint. So let's think about what happens to this function if you take a strictly feasible point. What happens if x bar is strictly feasible? Or let's not even worry about strictly feasible. Feasible. If x bar is feasible, what can you say about f of x bar, where mu is positive? What can you say of the value of f of x bar? It's small of fx. So this is equal to the objective function f of x bar. So when you transform it this way, what's happening is inside the feasible region, the function does not change. Why? Because the contribution of the penalty multipliers is 0 there. For every feasible point, I must have that bi minus gi x is less than equal to 0. I know that p of u at that point is equal to 0. So the contribution of all these penalty functions does not play a role in there. So inside the feasible region, I have fx bar is equal to f of x bar, little f of x bar. Outside the feasible region, now I have penalties acting. So it is conceivable that if I take a very large penalty, if I make this penalty really huge, what's going to happen? So here's what I'm going to try to do. My strategy is the following. I'm going to minimize f mu of x bar, or mu of x, for x in Rn. I'm going to solve this unconstrained problem. And the mu part comes from the multiplier. And let's say that the solution of this, the argument of this, is x star mu. It's the value at which the minimum is attained. If mu is small, do you expect x star mu to be feasible?
Say it again.
If mu is small, it's a small positive number, do you expect x star mu to be feasible? No. You know, you're just trying to minimize something over the entire Rn. There is no reason to believe that it's feasible. But as mu is cranked up to infinity, what do you think would happen to x star mu? What am I doing by cranking mu up? I'm trying to make points that are not feasible undesirable. Because I know that the penalty function is strictly positive outside. So as I crank up my mu, I expect that the points outside in the feasible region are going to start looking worse and worse. And you would start, if you're trying to minimize that problem, you will start moving into the feasible region. Unfortunately, there is no guarantee that you would get into the feasible region. You can come close to it, but you will not get in. Okay.
This extra mu, what is this indicating?
This is simply that for a particular value of mu, when I solve this problem, what is the x at which it achieves that minimum? And I want this x star mu to become feasible, but I'm only solving an unconstrained problem. So what I've done in the process here is this is the problem I want to solve. And I don't want to solve it directly because these constraints make my life tough. So I convert it into an unconstrained function by penalizing the constraints. And now by cranking up the penalty parameter mu, I'm trying to drag this into feasibility. Okay. So we have considered two different penalty functions. P of u to be equal to max of un 0, and in the example that I showed that's written out there, I'm actually using max squared of un 0. Up here, I'm taking the penalty to be max squared of un 0. Now, why would I prefer max squared over max? What's the difference between those two functions?
Quantity constraint. Max squared is steeper.
Max squared is steeper. What else? There's another.
If it's equality constraint,
Well, equality, that would be next question on this thing here. Equality won't work. None of these will work for equality. But so, the first one, okay. Let's.
It's smooth.
It's smooth. Max squared is smooth. Max is not smooth. So when I'm trying to solve this unconstrained problem, I want to make sure that this unconstrained problem is smooth. I should be able to take derivatives. Max is not a smooth function. So if I put penalty in here, I get a non-smooth function. Trying to minimize a non-smooth unconstrained problem is hard. So this is smooth, use this. But the unfortunate part is that the moment you smooth the penalty, you lose this. Feasibility becomes hard. Because, so think about it, I mean, intuitively what's happening is that the penalty function becomes kind of flat. It starts from 0 and kind of, it grows in a very gradual manner at the point 0. So if you're trying to force it to be feasible, it kind of comes and stops here because there is not enough power near 0 for it to push it into the feasibility region. So this kind of non-smooth penalties are good to make sure that X star mu becomes feasible, but bad because solving that unconstrained problem becomes hard. But it's something, so typically people use smooth penalties and live with some amount of infeasibility.
Is there an approach to solve the unconstrained problem without using the gradient?
Very slow. So it won't, I mean, it's all a trade-off between speed of solving that problem versus accuracy of the solution versus feasibility. If you want to be tight on everything, you want it to be feasible, you don't want to use the gradient, then you'll have to wait forever. So somewhere it has to give. Okay. Where is the unconstrained solution optimum? If I make it feasible, it's going to become optimum. Why? Because all the contribution to the penalty terms at a feasible point is 0, and therefore if I have solved an unconstrained problem and got a feasible point, that is definitely optimal. I don't have to worry about it anymore. Question is, will I get feasibility? Typically, no. So how do you, now the final question here is, how does one penalize equalities? What kind of a penalty function is one going to use? Yes?
At the point 0, there would the derivative exist. I think for the max to change, it would be.
It's 0 from this side and 0 from that side. So it's this, right? So at the point 0, this is what happens. So the question is, will the derivative exist? So this is max of x and 0. And what happens at 0 is this becomes like that. This is max of x and 0 squared. It's basically x squared for x positive. So at 0, the derivative is 2x, which is 0. So whether you come from the left-hand side or come from the right-hand side, the derivative is the same, 0.
Well, in the case of max, it would be 1 on one side and
0 on the other.
Oh.
Yeah. So that's why you like that. We like that because when you're trying to push it with using an unconstrained problem, you want to drive it in. Whereas here, what happens is that as it comes close to feasibility, its derivative is becoming 0. So it doesn't have power to push it in. Okay, question back there?
Was the original problem to maximize fx or to minimize fx?
So good question. This is, I think the question over there is, here we are taking it to be minimum. The example is correct. Is it? Did I switch it the other way around? Let's make sure that it is indeed correct. So what we want to make sure is, so this is correct. This expression up here is correct because what you want to do is have the values outside the feasible region to have a lower value than the ones inside. So if pi of x makes sure that the penalty functions are positive for infeasibility, then you're subtracting it out. Now it's possible that I screwed up on the signs here. I'll make sure that those are correct. So all of these should be negative. Any other questions? So the idea behind penalty methods is basically that if you can, so the thing that you should take away from here is the following. If you're willing to live with small amount of infeasibility, that you have these constraints, but these constraints are not something that you absolutely need to satisfy. You're willing to live with some amount of infeasibility, and in return you want an efficient method to get some point which is good enough. Penalty methods are good. All you do is solve a problem, increase the penalty multiplier a little bit more, solve it again, increase a little bit more, and so on, and it does converge to a good solution. Not necessarily feasible. All right. So let's take a break now, and then we'll meet again in the afternoon.